Thank you, John.
Great, thank you very much, Steve. Just get set up real quick here. Really looking forward to speaking to you all today about cyber risk and the diversification opportunities that it affords to investors. So thanks, Steve, for inviting me to talk to the folks today. For those who don't know who we are, CyberCube for the past 9 years has been the leading data and modeling vendor, specifically focused on supporting the insurance value chain, including fund managers in quantifying cyber risk, especially accumulation risk. We had the pleasure of working across all the major cyber catastrophe bonds that placed in Q4 2023. So really looking forward to speaking to you all about this today. It certainly wouldn't be a conference in 2024 without at least some mention of AI. I'm a little bit surprised there was only one mention of AI so far, so let's go ahead and add to the pile here. Let's go ahead and rip the Band-Aid off. So to begin with, I decided to ask ChatGPT to give me a nice little prompt as to what's going to help, what's going to increase cyber risk over the coming years. It's going to continue to evolve. I figured while we're at it, let's go ahead and ask it to draw a few pictures for us as well. Certainly, it did not disappoint. It gave me quite the list of different reasons for why cyber risk will be evolving over the coming years, quite a lot more than I was expecting. So I'll go ahead and just really rattle off the top 3 that it gave me. Really some great imagery here too. Really, it starts with AI, of course. You ask the AI, what's going to drive cyber risk over the coming years? It says, me, obviously, right? In the same way that those of us are going to use large language models like ChatGPT to help ourselves become more productive over the coming years, cyber threat actors, hackers will also be using AI to really evolve their approaches in terms of how they extort victims faster and at scale. We're already starting to see the use of deepfake technologies by threat actors. For example, last year in Hong Kong, there was a CFO who was deepfaked, which led to a low-level finance employee making a fraudulent transaction of $25 million. These sort of incidents are going to continue to occur on a more regular basis and have the potential to lead to a much larger scale impact. As the world continues to become ever more interconnected and as geopolitical tensions continue to rise, the potential for cyber risks will only increase over time. A few years ago, we might have just seen foreign interference with regards to social media, influencing people with regards to elections or perhaps cyber espionage between nation states. That's still happening today and will continue to happen, but more recently we've seen that these geopolitical tensions can and do lead to an underground digital war in parallel to a kinetic war. For example, on the day right before Russia entered Ukraine, most recently a couple years ago, Russian state actors are accused of hacking and shutting down a company called Viasat. They are a satellite-based internet service provider used throughout Ukraine for telecommunication purposes. So I'm not going to go too deep into nation-state attribution, exclusions, and things of that sort, but this is one of the rare cases where a cyber attack has actually been politically attributed back to a nation state by major powers in the US and the UK and Europe. Finally, as economies continue to digitalize, especially in those developing markets such as here in Asia, in Africa, and Latin America, the digital supply chain is going to continue to become ever more interwoven, interconnected, and centralized. Throughout many different industries and technology stacks, businesses continue to purchase convenience at the price of centralization. They've essentially concluded that it's more economical to outsource services such as web hosting, cloud services, and other critical digital services to organizations who specialize in these services. The implicit assumption is that these third parties have better infrastructure and security than individual businesses could muster on their own. And while the potential for a widespread outage of such services might be lower, the potential severity, if one were to occur, is significantly higher. These developments and trends show no sign of slowing down. But despite the current level of cyber threats and the risks they pose to businesses throughout the world, businesses are still not yet prepared to deal with the fallout of a cyber attack. This will, of course, vary by companies across different industries, different jurisdictions, and different sizes and budgets. But as you'll see by a recent survey from Munich Re, roughly 87% of businesses do not view themselves as adequately protected against cyber attacks. I'll let that sink in for just a moment here. That's nearly 9 out of every 10 businesses out there who don't feel they're well protected against a cyber attack. And in the face of a world in which cyber threats continue to rise, cybercrime is already causing businesses and society $10 trillion in 2024 alone, and this is only going to increase over the coming years. So for those businesses who feel like they've got a blind spot with regards to their readiness against a cyber attack, cyber insurance should be a surefire bet and should be a core component of a broader cyber risk management strategy. Unfortunately, that is not yet the case. The exact number will vary depending on the source and the specific area of focus of that source, but the consensus has become clear. The penetration of cyber insurance is just really low today. We can imagine that even in the underdeveloped and developing cyber insurance markets such as those here and around Asia, Latin America, Africa, those adoption rates are likely to be even lower than this 25% mark. And again, these will vary depending on what jurisdictions, what specific industries we're looking at, et cetera. For those companies who do purchase cyber insurance, they're often reported to have purchased lower or inadequate limits relative to their actual exposures, which feeds into the perspective of these folks who feel that they're unprepared or underprepared for a cyber attack. Now, perhaps the low adoption of cyber could be driven partly by the meteoric rise in rates seen since 2019. We had the pandemic and the sudden digitalization of businesses all across the world nearly overnight. This could have also had the effect of scaring off potential buyers of cyber insurance who might not have even understood what their actual exposures were to their businesses, let alone why cyber insurance was getting so expensive so quickly. Perhaps it was also then causing these purchasers to underinsure themselves. Things have been changing, however, when we look at the wider insurance industry, but specifically in cyber, there has been a softening of the market. So after years and years of double-digit, sometimes triple-digit rate increases, we are seeing now rates are starting to come down over the last few quarters. You know, arguably this could be a course correction to the huge rate increases that we had seen in those past quarters. So in all likelihood, there probably isn't a dire need for additional capacity today, and I think that was touched upon a moment ago, really more for the broader market, but this is equally the case for the cyber insurance market. At the same time, the insurance industry cannot afford to sit idly by until that need arises. It's going to need to partner with institutional investors in order to support the future capacity needs of cyber insurance, especially as cyber threats arise over time. So really, while the cyber market's growth has been volatile over the past several years, over the long term, especially as education and awareness of cyber threats amongst businesses continues to mature, the cyber insurance market is expected to grow substantially no matter who you ask. The particulars of the estimates will vary depending on which source, again, but there is going to be broad consensus that the increased awareness, education, and digitalization of businesses will only result in the cyber insurance market continuing to outpace the growth in the broader P&C insurance market. We certainly expect that to be the case even more so in the Asia-Pacific market and other developing markets. There will be more buyers of cyber insurance. Existing buyers of cyber insurance will increase their coverages and increase their limits. And there will be a continued increase in the underlying risk driven by wider exposure to technologies and an increase in those cyber threats and threat actors. If we assume that there was $14 billion of global cyber premiums in 2023, even a modest annual growth assumption of 10% per year moves the market up to about $40 billion in gross written premiums over the next decade. That more consensus growth assumption of about 20% per year gets us to a little bit over $100 billion in the next decade. And if we were to assume that aggressive growth assumption of 30% per year, we're now right over $250 billion per year of gross written premium. The cyber insurance industry is poised to become a key player in offering risk engineering and mitigation services as well. We've seen a lot of upstart cyber MGAs such as Coalition, AtBay, more locally Pandematics, really come to the fore to offer a holistic cybersecurity and cyber insurance product. Really, we're also seeing we're seeing incumbent insurers partner with cybersecurity firms and incident response firms to provide similar fully integrated cyber risk management solutions as well. Continued innovation in this space is going to require additional investment capital to help accelerate this growth, education of cyber risk to corporates and SMEs via the brokers, all to help improve their resilience against cyber threats. So one thing the insurance industry often has a poor reputation for is being too reactive in its path towards innovation. While a great innovation at the time and really planting the seeds for why we're all in this room today, the cat bond market really only developed in the aftermath of large cats in the early 90s, such as Andrew, Northridge, and some of the disasters in Japan in the early 90s. More recently, we've seen the industry react to COVID with the adoption of notifiable and communicable disease exclusions. However, with cyber, what we've already seen is the insurance industry and really the ILS investment community springing to action to help tackling these potential risks of systemic cyber events before they've actually occurred. This is much more proactive than we've seen in the past, of course. We saw 4 144.8 cyber cat bonds already so far in Q4 2023. All of these issuances were on a per occurrence basis. There are even reports of an active secondary market for these cyber ILS transactions. And increased interest and demand for cyber ILS transactions has been signaled by investors. We're now starting to see the traditional markets take note and begin to develop per occurrence-based reinsurance deals as well. Ariel Re and Hiscox Re, for example, have recently announced a consortium in which they're offering up to $50 million of per occurrence-based cyber catastrophe reinsurance coverage for events impacting hardware supply chain, software supply chain, services supply chain, and what they call cyber propagation events. And again, all of this is happening before a major cyber catastrophe has occurred. The insurance industry, but especially the ILS community, really should be proud of this achievement, but there is more work that needs to be done. So maybe switching gears here, coming from a modeling company, how do we think about cyber perils here? I like to draw a lot of analogies to the natural perils world, and so in the same way that we think about natural peril groupings, we can think of cyber catastrophe peril groupings along similar lines. So we might have major peril groupings such as earthquake, hurricane, flooding, etc. I like to think of these as analogous to what I would call the impact perils that I have on the screen here. So large-scale data breaches, long-lasting cloud outages, and widespread self-propagating malware, ransomware, perhaps digital impacts to physical infrastructure. As we look deeper into each of these major peril groupings, you might have sub-perils, for example, California quake versus Mexico quake versus Japanese quake. We can think of these sub-perils from a technology standpoint instead. For example, what type of service has the cloud outage impacted? Is it a cloud service provider? Is it some type of network service, perhaps an internet service provider? Is it a central payment service? And then we can go even further with these analogies. For example, the specific latitude, longitude of where the earthquake strikes. In cyber, that could be which specific cloud service provider, which data center was impacted, which of the availability zones. The magnitude of the earthquake could be measured in terms of how long that service provider was down for. Was it 8 hours? Was it 8 days? Perhaps that next question will be the blast radius of the earthquake. In cyber, that could be the question of which companies have a specific reliance on the specific cloud service provider or that data center. One area where this analogy does break, however, is with regards to mitigation potential. And this is one of the more exciting pieces when it comes to cyber. With natural perils, mitigation measures through building improvements and safety measures take years of planning and execution prior to the event. And when the event occurs, there's no amount of duct tape you can stick to the fault line to prevent them from splitting. You can't redirect an incoming typhoon by standing at the coastline and batting it away. But with cyber, the information security community has economies of scale potential when it comes to mitigating risk and impact. When a widespread software vulnerability is discovered, cybersecurity researchers and white hat hackers will often work together to rapidly develop a patch for that vulnerability, which can then be deployed at scale. So now I really want to get into the meat and bone of why we're here today and thinking through the questions many investors will have in mind if they're looking into cyber cat bonds. Is there an opportunity for diversification of investment portfolios through cyber ILS? For folks who have already invested in traditional property cat bonds, it might already be intuitive to see that there is diversification potential between cyber and natural perils. So despite all of my analogies thus far, a cloud outage is certainly not going to lead to an earthquake, and it's really difficult to see how a large hurricane or typhoon might lead to an increase in cyber attacks. But if we then shift our focus back to the 4 cyber cat bonds that were issued last year, we'll go ahead and deep dive into some of the diversification potential that is out there today. As I mentioned at CyberCube, we had the pleasure and benefit of being involved as modelers for each of the 4 transactions that were issued in 2023. And throughout the various investor meetings during that period, a question or perhaps an assumption that continually came up was whether or not cyber was fully correlated across the 4 deals that went to the market last year. So we dug into this, and initially, if we can go on to the next slide, there we go. Initially, what I should say is what's plotted here, each of these little green dots that you see on the screen here represent the underlying gross model losses of 2 of the bonds across the 4, across 50,000 simulation years, which we ran at CyberCube. Each of these dots represents a single systemic cyber event, which could then impact multiple deals potentially. We were then going through and measuring the pairwise correlation between each pair of the bonds. And as you see on the table to the right, really the initial returns were not all that promising. Just to say, I've obfuscated the names of the transactions here with alpha, beta, gamma, delta. I've since been reminded that alpha and beta mean very different things to investors, so just let me slide on that one if that's okay. But again, early returns were not that great. 90% plus correlation between all the different pairs of the cat bonds that we looked at. At the same time, given the attachment probability of all of these cat bonds were in the 2% give or take range, that's to say that investors are unlikely to be concerned with 98% of the potential outcomes across the gross underlying portfolios. So given the attachment points that are represented by the solid horizontal and vertical lines for each of these 2 deals here, the cyber events represented in that bottom left quadrant really will not impact investors nor their investments in these products. So what we then did is really focus in on the outcomes that investors really care about, where they could potentially face a loss to their investment. And so now here what we're looking at is going to be the loss of principal value to each of these 2 bonds. We're looking at beta and gamma on a scale from 0 to 100% on both the horizontal and the vertical axis. What you'll see here is that there's much less of a clear trend with regards to correlation. And if we look at beta and gamma on the table at the bottom right, what you're seeing there is a 25% correlation coefficient. I'll overlay some little helper highlights here, but if you look at the blue sections, what we're saying here is that for this pair, nearly 40% of the time, the model losses will only result losses in one bond, but not losses to the other bond. You could view this as almost full diversification benefit, potentially. The looks like it's the gray bit on the top and the right there. That's roughly 1/3 of the trials. We see that there's a total loss on at least one of the bonds, a partial loss on the other. Perhaps you could interpret that as medium correlation. And then, of course, the worst case scenario is on the very top right of the bond, the yellow bit there. About 1/4 of the model loss results we're seeing total losses across both bonds, full correlation essentially. So again, we repeated this exercise for all the different pairs of bonds that were out there in Q4 of last year, and what you're seeing is a 25 to 55% range of correlation between each of these pairs. So perhaps not as diversified as when we're looking at a product that is focused on, again, Japanese quake versus Florida hurricane, but not a bad start given these are all perils cyber risks covers. And given these are going to be all peril covers, perhaps it wasn't overly surprising we didn't see all that much diversification in the gross losses. Each of these 4 transactions were globally diversified portfolios, and their correlation against one another on an all perils basis meant that we already had seen a lot of diversification within each of the sponsors, within each of the cedents. So they had pretty much extracted a lot of the diversification potential from each of these deals, really. But as the cyber insurance and reinsurance market continues to evolve and mature, we can imagine a future in which there's going to be much more specialized and well-defined cyber cat bonds, similar to how we see this in the property cat space today. On the left, what I'm showing here is an adjustment to the initial underlying gross graph, where we're now showing the split between the major impact perils: outage, malware, breach, and physical damage. And then on the right, what we're showing here are going to be the correlation coefficients for malware on the top and then the outage risks at the bottom. So what we're seeing is lower diversification potential for the malware risks. Now these perils are typically driven by operating system types of events. So where there's a widespread malware on a Windows operating system, it spreads from network to network, system to system. Literally every company out there uses some kind of an operating system, right? I'm sure if I ask folks to put their hands up, do you use an operating system? Everyone will put their hands up. Probably 90% of you will put your hands up if I were to ask, do you use a Windows-based system? Now, when we then look at the outage perils, that better diversification potential, it really signals a difference in the specific technology dependencies that are used across each of the four portfolios. For example, you might have one sponsor who has a much more focus on writing large corporate accounts. Those large corporates tend to be more heavily indexed on major cloud service providers such as Amazon Web Services, Microsoft Azure, and Google Cloud. Another sponsor might have an increased focus on writing SME risks. Those SME risks typically use smaller, cheaper, and more niche online service providers. This is really all to say that diversification in cyber should really be focused on technology. That's going to be the path forward for investors, for the insurance and reinsurance community when it comes to future innovation in cyber. We're not going to find the same kind of geographic diversification as we have in natural catastrophe. It's not as tangible as what we're used to because you can feel an earthquake, you can see a hurricane coming. This will take a bit of a paradigm shift in terms of how we think about the underlying risk here. All to say, I certainly imagine a future in which these cyber catastrophe bonds will become more and more specific. Investors will become more educated about these risks, and we're going to be able to perhaps even narrow these products into peak perils, or perhaps even named service providers. Of course, it's still early days, so this is going to take time. And so perhaps the final question is, what's in it for investors? So what I've plotted here, and I took the liberty of scraping some information off the Artemis deal directory, but you're seeing on the blue points here the expected losses and multiples for property cat bonds, as well as the limited ELs and multiples for the cyber cat bonds. This is all to say that investors who have dipped their toes into the cyber cat bonds thus far, they're already taking advantage of these outsized returns relative to property cat bonds. Now, whether these higher returns represent a novelty premium, an innovation premium, or truly represent the risk premium, that's still a regular point of discussion. But of course, the sample size for cyber is still small. One thing has become clear, however, ILS investors are looking for new opportunities, and cyber represents a once-in-a-generation opportunity for investors to capitalize on. Investors who have been prepared by their asset managers have been able to take advantage of a novel risk and capitalize on the higher risk premium and add accretive diversification to their ILS portfolios. That's all to say that for those who would like to help their investor base capitalize on this once-in-a-generation opportunity, the time is now to start educating yourselves and your investors on cyber as an asset class. It's not something that they're going to be comfortable with overnight. It's certainly taken us 30 years to get to where we are today with regards to property cat bonds. So again, it is still early days with cyber. Again, it's not as visible, it's not as tangible as natural perils, so perhaps it's a little bit less intuitive. But as the world becomes more and more digitalized, cyber insurance will play an ever larger role in helping to shape cyber risk management of corporations across the globe. Shaping this is going to require additional capital to help fuel that growth and has the potential to be a great diversifier, if not outright providing higher returns to investors overall. If folks are interested in downloading the paper that where we actually performed the study, there's a lot of great information there. Here's a QR code you can use to then download that paper. But yeah, that's all I had for you folks, so really appreciate the time, and looking forward to our little fireside chat. Steve? Sit down.
Thank you, John. Very interesting. Interesting to see the innovation benefit that investors are getting paid currently, which seems to be bearing out in the secondary market as well, I believe. I hear the cyber cat bonds have held up very well in terms of pricing. and so investors are trading those actively, which is great to see as well. But I think you ended there by saying about education in the market, and I think it's really important to hear from you sort of what CyberCube is doing, but also how the industry is ensuring investors have got sort of an understanding of cyber risk. And there was with some of the issuances we've seen so far, there was a multi-model view provided to investors as well. Perhaps you could talk about the importance of that too.
Yeah, absolutely. So the education, the engagement piece is going to be the most important piece here, absolutely, by far. We've heard from multiple fund managers that whether they did or didn't participate in the 144As, or even the earlier private transactions that occurred earlier in 2023, the ones who were most successful in getting their investors to buy into this with the 144As already started planting the seeds years in advance. Even if they didn't dip their toes in the private transactions, they kept their investors well aware. This is happening. We're monitoring it. We're not quite ready yet. We're not going to recommend it yet. But perhaps when the 144As come to the fore, and there's a bit more of a wisdom of the crowd, perhaps, right? It's not just our own necks stuck out on the line there, that we'll go ahead and perhaps dip our toes into it. And again, ILS is a drop in the bucket for these investors' overall investment portfolios. Cyber is even a drop in the bucket within ILS today, of course, right? So it really has taken time for investors to get that educational piece. I certainly saw this a lot during the 144A transactions. The first couple of transactions where we were in these roadshows with the investors, we were getting grilled left and right about how can you possibly quantify this risk? How can you model it? It's so dynamic. There's another human being on the other side of the table. We don't have the years of science and events and model validation. And as we were explaining our approach on how we think about modeling cyber risk, really breaking it down piece by piece across the who, what, where, whens, and whys. Who are the threat actors and what are their motivations? And again, these are human beings. Human beings all have very similar motivations across financial means, political or ideological means, et cetera. Having cybersecurity experts who we can rely upon to understand what the technical vulnerabilities are, and how those are accessed and how those will be utilized by threat actors, and then what those downstream implications are. Breaking things down to that more bite-sized piece, those bite-sized pieces really helped to get the investor community more on board over time. It took a few of these conversations, and we had the benefit of having 2 or 3 back-to-back roadshows, of course, right? By the time we got to the index-based deal, there were no more questions about, can you model cyber risk? At that point, it was really about, well, how do you construct the industry index? Is this going to be an appropriate industry index for the U.S. cyber insurance market? So you could see the evolution happening over the course of those 3 or 4 months pretty rapidly.
And it's been fairly rapid in the development of products like indices as well. I think we already have 2 available for the market, so that's great because it more optionality for sponsors as well. But you mentioned sort of the early roadshows and when those first cat bonds were going to market. What were the kind of questions that you were getting? Were they about cyber war and whether that's excluded? Was it the typical things, or are investors quite thoughtful about these from the off?
Absolutely, very thoughtful. I mean, investors they're a lot of sharp folks, right? They ask a lot of really sharp questions. In terms of things like cyber war, things like nation-state exclusions, and of course, this is right around the time when the Lloyd's cyber war exclusions were first coming to the market. Munich Re and some others were also coming out with their versions of systemic cyber event and war exclusions. The cat bonds themselves would have an extra layer of protection, of course, right, in terms of excluding cyber war, nation-state-backed criminal events and things like this. So that was certainly part of the focal point. I think with the cyber cat bonds that we had seen, the attachment points were at a reasonably high enough level to give investors comfort that it would take quite a large event to get to that point. And even if there were to be one that could potentially be designated as war, there's just still so much uncertainty as to whether that can actually be attributed. Probably more for the benefit of investors today, because attribution doesn't happen very often. I mentioned the Viasat attack earlier. I think that's really the first time that there's been a formal attribution by major powers of an event back to a nation state, in this case Russia. NotPetya back in 2017. This was another one between Russia and Ukraine where a Ukrainian tax accounting software was impacted by malware. It spread into the operating system and then spread like wildfire from there, beyond the borders of Ukraine into companies in the US and Asia and Europe that interact with Ukrainian companies. Even then, there wasn't the same positive, affirmative attribution back to Russia. We got really close. I think some leaders said, yeah, most likely it's probably Russia, but we're not going to confirm or deny this, right? So that's certainly a hairy situation that investors focused in on, but I think that they got over the hurdle with the types of returns that they're seeing here. There's obviously the uncertainty, the risk premium that's being added for that uncertainty, of course, too, in addition to that higher attachment point.
One of the other things that comes up a lot at the moment, it seems, in the reinsurance industry in general, is around the need for capacity. There was, if we go back a couple of years, everybody was saying that there's a lack of retrocession that's hindering reinsurers. They can't provide enough capital to insurers, and it was thought that ILS would come in and support that and help to build out the market. But there seems to be a slightly difference of opinion emerging at the moment around the potential size of insured cyber catastrophe losses and whether they can really be as large as some people were originally saying. Wondering if you've got any thoughts around that, and because obviously that can have a bearing on the demand for capacity.
Yeah, it's a great question. I almost view that as, it's more of a more bullish case for the opportunity right now in terms of for investors to capitalize on those higher risk premiums, on those higher spreads for cyber relative to Nat Cat, if that is the case. Now, the jury's still out. As I mentioned earlier, we don't have a huge historical record of cyber catastrophes that we can test these models against, test the pricing around, et cetera. Similar to the natural catastrophe world, we could see a situation where you have periods of peaks and periods of troughs. We're starting out in a long period of a trough potentially when it comes to cyber catastrophe activity. But again, as this continues to evolve, as events start to emerge, we could see this change quite rapidly. We have seen what I would maybe even call mini catastrophes or kittens, perhaps. In the US, you've had Change Healthcare, for example, is a very recent example of an event where a supplier for the healthcare industry was impacted by extortion, by malware, and that essentially shut down the entire healthcare industry, or at least a wide swath of it in the US. They were essentially a payment platform for healthcare providers, and so these healthcare providers couldn't get reimbursement for claims and coverage. Very industry specific, but we are seeing these types of events take place. Now, the question as to whether or not a bigger one will hit, we keep monitoring this. We keep seeing what seems to be near misses or potentially more. It could be more catastrophic events. Thankfully, it hasn't become one yet in terms of a multi-billion-dollar event. But certainly something that I think not doing something about that is certainly not a winning approach. Right? We certainly have to be proactive as a market.
And I suppose what's interesting with cyber as well is that we see we don't yet know the potential scale of catastrophes, but we do know that the economic exposure is growing exponentially year after year.
Absolutely.
You spoke about diversity within the 4 cat bonds that have been issued so far. Perhaps you could talk a little more about where you see diversification coming from in future within the cyber space, and whether that could include potentially direct corporate deals, more focused on things like cloud outage. Where are you sort of bullish for?
Yeah, absolutely. So the diversification that we've seen so far in the 4 cat bonds, as I mentioned, they're already kind of pre-diversified within each of the sponsors. So it's really more diversification via structure is probably the first one, and then a little bit in terms of the underlying risks and the technologies that are there. As we go forward, I fully expect to see diversification potential through different peril coverages offered, similar to having one product for earthquake in Japan, another product for hurricanes in Florida. I wouldn't be surprised if we see a very specific cloud outage cat bond, maybe one that covers the 3 top cloud service providers, Amazon, Google, and Microsoft. Another really exciting area of development will be in parametrics, of course, and go back to cloud. That's going to be probably the most obvious case of where parametrics, can play a role in cyber. So if the cloud is down for X number of hours, the sponsor will be paid X times Y dollars in terms of coverage. You could potentially even layer this using a blockchain approach, smart contracts, et cetera. such that the sponsor can get immediate indemnification once a cloud outage does occur. So these are the types of things that I could certainly see come into the fore in the future. The traditional markets have been mostly quota share and aggregate stop loss based, so seeing the first industry index deal has been really promising. We'll probably see more of those with different indices that are out there as well. Once again, it's really early days here. There's a lot of innovation to be had here in cyber.
No, that's great to hear. It might be very interesting for somebody smarter than me to develop a sort of outage options platform. It could be something that's eminently tradable, it seems. From the dedicated ILS asset managers themselves, what was the reception to first the models and then to the cat bonds? And I know that we had a fairly decent number invested in these first few deals, but there are still others who are sitting on the sidelines looking at it, and obviously cyber doesn't meet everybody's mandate yet either, but I also understand there are managers looking at their mandates and whether they should be adjusting them. Do you think that's going to happen over time? Do you think we'll see a broader spread of investors behind these deals in future?
I certainly think so. We're already hearing murmurs in the market that there are more and more investors and fund managers who are now more seriously investigating this as an asset class. They're starting to educate themselves and, again, their investor base on the types of opportunities that cyber presents to that investor base. It's going to take time. It's a different language. We're starting by trying to speak the same language that folks are used to with regards to these perils and sub-perils, impact zones, blast radiuses, and things like this. And I think having the 144As, where again there are other participants out in the market, we're kind of sharing the load amongst all the investors that are out there. Also, you're really learning from one another too, in some ways, right? Conferences like this, of course, and the interactions and the networking that we have here. So I think over time, and to the extent that more sponsors come to the table for additional coverage through the capital markets, there's going to be more opportunities for investors to dip their toes into this space on a limited basis. Maybe the mandate starts at a really very small sliver. I'd say cyber ILS is probably 1% of the overall ILS market today. So perhaps it starts with that, but perhaps those mandates grow to allow investors and fund managers really to have room for growth as the asset class becomes more attractive, as they educate themselves more over time. As new products come to the fore that are more specialized, that really fit investors and fund managers' specific risk profiles and risk strategies. And I think that's going to be the most important thing is, can we cater these products to those risk strategies over time as well?
And I think with cyber being digitalized, obviously it is probably much easier to calibrate transactions to meet specific risk return requirements as well. So there may end up being much more diversity in that respect too.
And one of the other things there too is there's a lot of data that's out there. I mean, literally what we're talking about here, cyber risk, it's all digital. It's all ones and O's. It's all just packets of information going back and forth between different servers. There were some comments earlier about the lack of data for the property cat space in Asia Pacific and elsewhere. That might be the case in terms of cyber today, just in terms of what folks are getting themselves access to. But the data is out there. Folks are looking for it. And so to the extent that we can provide this, a more palatable version of this data to investors that they can understand and comprehend to, again, help educate them as to what the exposures are, what the risks are, starting with these analogies to what they're used to in the property cat space before we then move into a more digital native language, perhaps. Really, the data is very powerful here, and it really tells a great story in terms of why this is not only a great investment opportunity, the risk is quantifiable, it is understandable. But again, what I think is most exciting is that there's more that you can do in the event of a cyber catastrophe than just sitting, lying on your back. You can take measures. You being the companies that are at risk here can take measures to then help really defend themselves against these cyber attacks. And I think this is where the insurance industry is really going to play a huge role here, in terms of evolving into risk engineering services and mitigation services, investigation response services, et cetera.
Yeah, it's interesting that that's something that insurers in the property space are now increasingly getting into, but in cyber it's there right from the off, which is great to see. Let's see if there's any questions in the audience. We've got about 5 minutes before the end of this session. No hands up. Oh, yes, sorry, we have one over here. There's a mic coming your way.
So there was a slide that John put up earlier that showed the price multiples on the 4 cyber cat bonds compared to the price multiples in the property space. If you look at the 4 cyber bonds, the multiple can mask differences in spreads somewhat, but it does look like there was quite a range of spreads if you unravel it that transacted on the 4 cat bonds. And I was wondering if you had any thoughts as to why there was such a divergence in pricing, where the risk and those 4 portfolios were essentially similar, globally spread, diversified books.
Yeah, that's a really good question. I think some of this, and I might get a little bit cheeky here, but some of this could be driven by the fact that this is such a new peril. And with that, a couple of the sponsors made the decision, different to what they would normally do in the Nat Cat space, to offer alternative views of risk to their investors. So a couple of the transactions had 2 distinct views of risks. And I think today, with the nations of cyber risk modeling, cyber as an industry, the modeling approach is taken by the different modeling vendors, such as ourselves and some of the other ones that are out there. We take very different approaches for very good reason, right? And the difference in the EL, I think, in the spreads really perhaps could be representative of the difference in opinion in terms of those views of risk. I think where we are today, one thing that really forces the industry into doing with those divergent views of risk is really ask the question, why do these different modeling vendors have such different views of risks? Asking how are they actually approaching the peril, how are they modeling the who, what, where, when, and why, how things could unfold. But I think it really came down to that, perhaps. Those that had multiple views of risk could have given investors an additional benchmark. To the earlier point that was made, these models are all good benchmarks. You've got to compare them against something. But when you have multiple benchmarks in place, which one do you then rely upon?
Are there any other questions in the room at all? No hands up at the moment. So perhaps we could close off and you could talk a little bit about, given where we're sitting today in Singapore, about the Asia-Pacific region and perhaps how cyber catastrophes could be nuanced between different regions of the world.
Yeah, it's a really great question. And I did say earlier that there's less geographical diversification in cyber. That's certainly the case, because when we think about technologies, technologies are in fact global. Again, operating systems, that's an obvious example. Cloud service providers are very global in nature. You may have some more regional players. For example, in China, they'll probably use more Alibaba Cloud and Tencent Cloud than they will Amazon or Microsoft or Google. But then you skip over to Japan, which is very, in many ways from a business and a geopolitical standpoint, very aligned with the Western world. And there's a very similar usage there, if not more so, of those top 3 cloud service providers in Japan than what we see in the US, in fact. Now, that said, there will be some nuances in terms of specific industries using specific technologies that are homegrown. I talked about Change Healthcare earlier. That is a health service platform in the US. I don't believe that's really used more broadly in the rest of the world. You could have very similar, what we call single point of failure technologies or SPOF technologies, say in Asia Pacific, that's very specific to the local financial markets. The underlying risks are actually a little bit different too, if we do peel back the layers of the onion. When I think to the US, most of the cyber risk that people are worried about there is with regards to malware, ransomware, double extortion. We flip over to Europe, and perhaps with the higher GDPR requirements that are in Europe, data breach is a huge focus there. Over here in Asia, there's still a large manufacturing industry, and so what folks are really concerned about with regards to cyber risk is their factories getting shut down due to a cyber attack. And so the nature of the risk geographically will differ a little bit, and so that will lead to potentially differentiated products for different jurisdictions, really for specific industries, I should say. The other thing that I find interesting too is, having been in Japan over the last week, One comment that I'd heard is that just the Japanese language itself is a bit of a mitigant towards cyber hackers and threat actors. If we think about, the typical stereotype of, Russian or Ukrainian hackers, attacking the U.S. or Europe, sometimes with emails that have a little bit of broken English in them or whatever else. In the Western society, we're used to English being the lingua franca. Everyone is speaking English with various levels of confluence. Over in Japan, for example, it's a very homogenous society, or much more so, I should say, than out west, where if someone were to get a phishing email with some broken Japanese, that probably raises a few more alarm bells than they otherwise would. So there are certain cultural and regional differences from that regard too that are worth thinking about. How that actually then evolves into actual cyber threats and systemic cyber events. That's a whole question in itself that we're still actively researching, of course.
Brilliant. Thank you very much, John. That's all we've got time for with this session, so please put your hands together to thank John for his insights.
Thank you very much.